Hi, I'm Jonathan DeYoe with DeYoe Wealth Management in Berkeley, California, and today we're going to talk about what impacts stock prices. Now this is actually a very good question for me, and I think there's two really good reasons that stock prices move. The first and most obvious and obviously predictable is earnings. The most critical element that goes into the valuation of a company is what do they make. If the first is earnings, and it's easy to determine, the second is the really difficult part, and that is how much are we willing to pay for each dollar of earnings? And this is investor emotions. So if you think back till the dot-com boom of late 1990s, people were willing to pay $40 and $50 for each $1 of earnings, whereas in today's market, people are only willing to pay $14 or $15 for the same dollar of earnings. And so when you look forward, you can think that if we expect a company's earnings to increase, we will, agree to pay more and more for that company, the shares of that company. And if we expect that the company's earnings will decrease, we'll actually not pay as much for the shares of that company. Now, the combination of these two things, the earnings and the price we're willing to pay, is often referred to in the P/E ratio. That is the price per unit of earnings. Now, there is no perfectly acceptable P/E ratio. Different companies have different types of earnings and different sources of those earnings, different rates of increase and decrease. So oftentimes, many different companies are going to be valued differently in a market, which is why it's so incredibly important for people to be broadly diversified with lots of different companies in their portfolios. I'm Jonathan DeYoe with DeYoe Wealth Management. Thanks for listening.